friends. Thank you for joining us today. As I sit here on the Anishinaabe territory as an unwelcomed guest, and for those who are not from Canada, Anishinaabe is the original territory where Canadians call themselves home now. I often ponder over the future and really when it gets clearer and better. And my sentiments are quite the same on the topic today. How can we leverage intelligence and data, and when does it finally get better for financial institutions in our fight against financial crime? So I am, by the way, sipping on an Americano that I made with ethical bean coffee, which actually allows you to trace the entire supply chain. So I really encourage you all to look it up. And no, they did not pay me to say this. I am a fraud investigator, as some of you know, and also a big part of the TCAE family, and have been for the past 15 months. Many people have reached out privately to ask me how they could join. And a lot of my friends are here today to support me, who've also asked me how they could become a part of TCAE. So I just wanted to talk quickly about my journey here as an integral part of the community. I was a disheartened CAMS candidate who had failed twice when I first found TCAE back in April 2020, and I joined the study batch. And then soon I joined a knowledge series session on the financial side of human trafficking, where I met Timianagi, a survivor of human trafficking. And that's when Suzanne and TCAE had introduced me to my calling to abolish modern day slavery, which I am actively a part of the movement now. And then I began, of course, I passed my CAMS, with flying colors. There is no question about that. And then I became a member by contributing to content and research. And I am now the editor of the events letter, and also finished my chain analysis courses, CCFC and CRC, through TCAE. And finally, founded a club on a Clubhouse, which many of you are part of, thank you, which is called the AML Junction. So this is what I do, and I have benefited tremendously professionally and personally. And so for those of you who've asked, what could they do? I think the answer is there is really no method to this madness. Just do what you love, and I promise you TCA will support you in all your initiatives to become a better financial crime professional or anti-financial crime professional. And without further ado, I want to introduce our speaker and share some of my thoughts on intelligence sharing. It's something we've talked about for a long time, for decades. Sometimes feels like data sharing is an aperture into the future, but then it feels like a closed door, a door shut in your face. And people who work in financial institutions especially might resonate with this. As someone who investigates crime rings, I'm much too familiar with the barriers we face, even within an institution, when we're trying to get pertinent information. So we have an expert here who has been in the industry for 20 years. Her reputation truly precedes herself. So she's not only worked in a multitude of sectors, but such as IT, banking, consulting, but she's also worked in 7 jurisdictions. In the span of the last 4 months since I met her, she has been awarded the Risk Professional of the Year award by Waters Technology. And then she's also the winner of the Fraud Prevention Award in Anti-Financial Crime Awards by TMIS. She writes extensively for Corporate Compliance Insights column and has been referenced countless number of times in various publications, including The Economist, Bloomberg, AML Intelligence, the GRC World Forums. She's been interviewed by many organizations like ACFCS. And lastly, she was also featured in a book called Sending the Elevator Back Down, what we've learned from Great Women in Compliance, which was also published by Corporate Compliance Insights Media. And of course, as far as TCAE is concerned, she's a seasonal favorite. She was featured as one of the 8 women in compliance on International Women's Day 2021. And we really could not be more thrilled to have her back. Now, before we get started, there is another player in this conversation, an integral part of this interactive conversation, and that player is you. So we want to get to know you. Your participation matters. And so, Sujata, if you could go on to the next slide, please tell us who you are and what best describes you. Beautiful. Thank you. So there are many other professionals. Please tell us what you do in the chat, if you don't mind. And now welcoming Sujata Dasgupta, the head of financial crimes at Tata Consultancy Services. Welcome.
Thank you, Janisha. And it's wonderful to be back at TCAE. So I've been here before. And like Janisha mentioned, even I enjoy this forum as much as everybody else does. I really admire the work that Susan and her team at TCAE have been doing for this community. And I'm really happy to be associated with all of you, sharing whatever little I know and learning a lot more in the process as well. So I hope, Janisha, if you can let me know that you can see my slide properly. What happened?
Not yet.
This doesn't seem to move. Just give me a moment. Maybe I'll stop and share back again, if that's okay.
Sure.
Just a small technical glitch there. Just a moment.
In the meantime, the reason we're here, and I think Sujata's slides are back on.
Yeah. You can see my next slide, right, Janisha?
Yes, wonderful.
Yeah. So in case, this gets stuck again, so I'll do the same thing. I'll just stop sharing and come back again. So yeah, Janisha, were you about to say something, or should I start?
No, go on.
Okay, so the topic for today that I decided to speak about is, how intelligence and data sharing can benefit the industry. By industry, I mean the financial institutions. There's a huge ecosystem of financial institutions like your banks, your money service businesses, your credit unions, the regulators, the fintechs, the regtechs, the law enforcement. So there is a whole lot of institutions in the whole ecosystem which require to work together, but there are some challenges which plague them. And what are those challenges? What are the benefits that they gain by working together? Why they should work together, and how the industry has been moving forward in this process? The kind of thinking, the kind of regulatory aspects, the technology aspects, the process aspects. So this is what I decided to talk about today. A brief history, if we look at, when this whole anti-money laundering and KYC started, I think, to my knowledge, it's about 1970 when the Bank Secrecy Act in US was, it was the first piece of legislation that I know of. That was 51 years ago. And at that time, it was really thin. It was very light at that time. And from there, if we see where we are now, 51 years down the line, there has been so much of regulatory stringency. And that has been because the kind of crimes that we are witnessing has expanded. So earlier, we only used to see, money laundering. Then it got amplified with things like fraud. Then we have sanctions. Now we have your crypto crimes, environment crimes, your cyber crimes, even waste dumping and illegal wildlife trafficking. All of these things have got added, and these have now got added into the regulatory landscape as well. So the point I'm trying to make here is, as crimes are getting more complicated, the way the industry is trying to tackle it is also getting more stringent. And now that, now we are at a stage where we are talking about, not working alone. Financial institutions or regulators or law enforcement, they cannot stand isolated and work on their own. It has to be a collaborative effort. Now, why does the industry need collaboration? So you could think of several reasons. I have just picked the top three here. So first thing is, our opponents here, the criminals, they don't work alone. We know that no single money laundering or a wildlife trafficking or a human trafficking, you take any predicate crime for that matter, it's not a single person crime. It is an organized crime. So if the criminals are organized, institutions cannot be fighting them alone. So it's like a battlefield where your opponents are in a group. So your defense also has to be in a group. So you have to collaboratively fight against the organized criminals. That is number one. Secondly, we have seen through these last 50 years that criminals tend to find the weakest links. So like I said, there are a multitude of banks and financial institutions. There are some which are very strong in their prevention and detection mechanisms, while the others may not be at that level of sophistication or maturity. So when criminals try to move their illegally gotten money through the stronger financial system, and they get stopped there, they tend to find somewhere where there is lesser resistance, somewhere where the controls are weaker, and they tend to flow their money in through that channel. So if these organizations were to collaborate and come together, probably they could identify that there are certain weak links, there are certain controls which are below what should be the industry best practices, come up with some standards, and every organization can then be at a level playing field, so that the loopholes cannot be exploited by criminals. So that is the second, where you identify the weaknesses and set the standards where everybody everybody follows the industry best practices. This is the second. And the third is sharing intelligence, where if one institution has identified a criminal, that intelligence can be passed on to the other organizations as well, so that they can also be cautious, probably put them on their watch list, or put them on the internal watch lists, I mean, or monitor their activities more cautiously. So these kind of intelligence sharing is what is also helpful, I believe. So in terms of intelligence sharing, I can think of something like CFAS. I mean, there are several. I mean, each country is trying to come up with something like that. So there is something called CFAS, CFAS in UK, which is coming up with a fraud database where the participant banks can look it up. So whenever they are say onboarding a new customer or doing a due diligence, they can look up that database and check if any of their customers is mentioned in that database. And that is a database where the participants are contributing to, as well as they're the end users. So it works both ways. So I think these kind of intelligence sharing models is what will strengthen the overall financial system in the fight against the criminals. Here I've tried to identify some benefits. Again, like I say, there could be several more. These are just the few that I have listed over here. Customer data, as we know, customer data is the backbone of the entire prevention, detection, investigation. The whole cycle is heavily dependent on customer data. And then, of course, there are accounts data, transactions data, all that is important. But the transaction and account information is generally generated by the banks themselves. So that is available within a bank. But the customer data is something which the customer provides initially during onboarding, and then it generally changes over a period of time. But it's not always that the customer comes and updates the bank, right? So what the customer data that a bank may have may not be accurate, may not be consistent, or there may be missing information, dummy information. So all those kind of data quality issues are something which we witness every bank is facing. Now, if uh, if banks were to collaborate and they were to share information, insights, I think these kind of gaps could also be addressed. Uh, if I have to take my own example, I have account with 3 different banks, for example, and I have opened them at 3 different points of time for different reasons. I have a savings account at one, I have some cards account at another, I have some securities account at another. So I have opened these at different points of time. So the information that is there is also different. My addresses have changed, my income levels have changed, my contact details have changed. The industry that I work in, like Janisha mentioned, I initially worked in a banking sector. I was as part of the I was working in a bank, then I moved to IT services. Now I'm into a consulting organization. So all these information, it's not that I go and inform the bank every time, but because I have onboarded 3 different banks at different points of time, uh, if they were to collaborate and get my information, they would have a much more consistent and accurate, complete information than what I had provided them, say, 5 or 10 years ago. So this is something which customer data benchmarking is one of the use cases which could strengthen your customer data, which again is the backbone of the rest of your prevention, detection, investigation cycle. Investigation. Now, as we all know, when there are red flags or when there are alerts on any of our customers for either for any breach of any AML scenario, or on the sanctions list, or on the fraudulent activities, these alerts need to be manually investigated. I mean that is the situation now, that most of these, though over 90% of them turn out to be false, but yet they have to be investigated manually. Now, one of the main reasons of these false alerts is that the customer data itself was not accurate. So the example that I gave, the first bank where I onboarded, my income level was much lower. So when I make a fund transfer or when I make a purchase, that bank will throw up an alert because my anticipated activity is much lower at that bank. Whereas the bank which I onboarded last year, they have more accurate information. So they may not have an alert triggered when I make the same transaction there. So because the customer information is different, the alert triggered would also be different. So the point I'm trying to make here is, if the customer data is not accurate, if the customer data is not up to date, then there is a chance that there will be a lot of false alerts. So in order to improve your investigation also, there is this intelligence and insights from other banks can also help. Of course, there are other things also which can help. For example, if you the one I was talking about was a false positive, but then if you think that an alert could be a true positive, and you need more intelligence around it. I mean, that is where it gets more complex, right? When you do more detailed due diligence on that particular customer, his account, his transactions. At this point, if you could get some intelligence from another bank where the same customer has an account and where he transacts through, I think that intelligence also helps, that they would also give you some information. For example, yes, this is a general activity, or no, this is not something usual. We have also flagged something similar. So I think these kind of collaborative information, it augments the investigator, the analyst who is working on the alert. So that could also be one of these cases. Then the due diligence effectiveness. Of course, it's all about, again, data, because we are talking about data sharing here. So most of these use cases will be about data only. So again, we are now moving towards a more dynamic review, and moving away from the periodic review of customers to dynamically update customer records. Now, like I said, customers do not generally come to a bank and inform, but then through their activity, through their transactions, through the products that they are using, through the type of fund transfers that they are using. It generates a lot of insight about the customer behavior, about whether there are any deviations from the normal, whether there has actually been some update to his information. So these kind of information, if if one bank identifies some change in the behavior and notifies the other, I mean, if the other banks are able to take advantage of this update, I think they can all holistically do a dynamic review of the customer also. So this is something around the higher due diligence which can be done through intelligence sharing on a regular basis. Network identification. Now, I may have one customer in my bank. He may look all genuine, but then this customer may be connected in some way to another customer in another bank who may have some criminal links. So for network identification also, this proves beneficial if the financial institutions can come together and share intelligence and find out some, whether there are any anomalies or there are any proximity to any criminal networks. So there is a case study which I will talk about in one of the upcoming slides, where some banks are coming together to identify some where they pool all the transactions of all customers in a particular country, and they try to look at patterns and networks. So that is what I will come to in one of the next slides. But Janisha, please let me know if if I'm going too fast, because there is a lot of information, and if there are any questions, I'll be happy to answer in the interim as well.
No, you're doing good.
Yeah. So around fraud prevention, also the example that I was taking about CFAS, that's a UK-based non-profit organization, CIFAS, that has been formed to make it a database for sharing fraudulent information. So a customer who has been identified to have committed some fraud is entered there. That is one way where you share details about fraudulent customers. But then there are other things. For example, the same type of fraud is never perpetrated year on year. The criminals always find out new ways and means of committing some new kinds of frauds. So if banks come together and they pool their insights and data, they might be able to come up with the new typologies. What are the new patterns of crime, like what we saw during COVID? I mean, there were countless number of frauds which proliferated during COVID itself. I mean, it's just 1.5 years, and we saw maybe 5 different types of crimes. For example, there were employment and money mules. I mean, who were given some amount of money to move some large funds, and people did that. They fell for it because they had lost their jobs during the pandemic. So that gave rise to an employment, money mules because of that job losses. Then there were frauds with COVID equipments. I mean, they were selling fraudulent equipments, and they were making money out of it. People were vulnerable. They were trying to buy those kits and those whatever masks and PPE equipments, detection kits. So people were buying without knowing for sure that these are genuine or not, but the fraudsters were making money out of it. Then there were charities fraud. Then there were the PPP, or the bounce back loans. What the bounce back loans were in UK. In US, you had these paycheck protection programs, and these were all done in a very quick timeline, in a very short timeline. The government had to disburse all these paycheck protection. So these were kind of loans which had to be disbursed, and a lot of unscrupulous individuals or organizations, they started onboarding these banks and fintech, saying that they also were in need of funds, but they were all fraudulent. So a lot of fraudulent loans were also dispersed. I mean, loans to fraudulent individuals and entities were dispersed. So just COVID itself it showed us that there could be so many different of crimes that could proliferate from just one situation. So imagine, I mean, fraudsters are continuously thinking of ways to come up with new crimes. Now, if banks were to pool their data and they could see a pattern, they could come up with new typologies and create those prevention detection mechanisms early on, so that it's not after they have lost a lot of money. So that can happen early on. And then, of course, the reporting angle. We all know that the SARS, or the true positives which are identified by the banks, they have to be reported to the FIUs. That's part of the regulatory body. Now, what we hear when we hear regulators speaking, they say that not even 10% of these SARS actually have a lot of useful information. So whether it's FinCEN in US or the other FIUs in the other countries, they say that they are swamped with a lot of SARS. They get a lot of submissions, but then just less than 10% of these actually have information based on which they can take some action, or they can take some next steps, or it's actually some good information. So I think the quality of these reports can also be enhanced if there was if this data could be enriched through collaboration. So I think these are some of the use cases that I have mentioned here. Again, definitely not a full list, but this is some of the things that we are seeing that the industry is also looking at in terms of collaborating. Janisha, is there something you want to say?
Yeah, I want to ask you a question.
Sure.
But I'll let you finish this slide because it's relevant, and then I'll interrupt.
Okay. So we spoke about why we need to collaborate. We also spoke about the benefits that collaboration would accrue to the entire ecosystem, starting with the financial institutions, the regulators, the law enforcement. But why has it not happened so far? So there are some challenges. So though we acknowledge that this is important and this will be beneficial, there have been certain challenges. So the first, I think everybody is aware of the data privacy laws. It started with the GDPR in Europe. It came into effect in 2018, but it was announced, I think, a year before that, 2017. And the GDPR has been a trailblazer. It has changed the game completely in the context of customer data security, data privacy, how institutions can store, manage, disseminate, use, and even purge. How long they can retain and by when they should be purging data. So it has completely changed the game in terms of customer data. And soon after the GDPR was enacted in Europe, I think every country after that, almost every country has some version of data privacy. They're called by different names, but almost every country has it. I have just cited a few over here, but then, I mean, if you just search, you will find one in your country as well. So what these data privacy laws tell these institutions is that institutions hold a large amount of our customer data. For example, when we are onboarding, we give our entire information, our personally identifiable information, for example, our IDs, our social security details, our addresses, contact details, our income levels, our source of income, everything is there available with an institution. Now, that makes these institutions the custodians of our data. And with the enactment of these laws, they can only use our data with our consent for the purpose that they need to process it for. So it is very, very restricted now. So they have to be very careful about collecting data in the first place. So there are two aspects to it. First is it's called the data minimization. That is, the institutions must collect only that amount of data which is required to process the activity for which we have onboarded into the bank. So that's data minimization. And the second is, I think it's called purpose limitation. That is, it should be used only for the purpose that it's collected. So if I go and onboard in Bank X, it does not mean that the Bank X can go and share my information with everybody else just because they want to collaborate. Have I given my consent for it? That is the first thing. And if I have given my consent, what have I consented for? So these are the things which are, very these have to be taken very, very cautiously, and that is the reason that these are not shared amongst institutions so much. But FATF has a clause. I think it's called the recommendation number 18. I think I read in one of the reports that FATF has allowed through its recommendation 18. It has allowed financial institutions to share data about their customers, their accounts and transactions within their group. So if I were to talk about a city group, now city group has its own, say subsidiary organizations. So it could be a city mutual, it could be a city bank, it could be a city direct or whatever. So city is allowed to share its data within its group, but not externally. But the topic that, the use cases that I was talking about was more about sharing externally as well. So it's not just internally. Internally is also required. That's good. But we're also talking about externally. So FATF had not specifically mentioned that. Now, as we see this growing need for sharing data, now Europe has come up with its, the last year when they enacted the EU fifth money laundering directive, they have come up with a clause there. I think I don't remember. It's some clause 42 or 46 somewhere, where they are talking about sharing data amongst other financial institutions also. I mean, that's externally. But then again, within the data privacy laws. So it cannot violate the data privacy laws, but you are allowed to share. So at least now we know that you can share information, but then of course your data privacy law is also to be taken care of. So you have to find out ways of sharing information without violating that law. So that was about the data privacy law. So the regulatory guidelines. Now, I was just talking to you about the FATF and the EU. So these guidelines, they say that you can share information, but how? I mean, if we have to adhere to both, there is clearly a conflict, right? So that is not very clear as to how we can overcome this, overcome this whole conflict there, and yet share data. So there is some ambiguity there. So we are awaiting a lot of regulatory guidelines. I know in Netherlands, it has been pending before the Dutch Parliament and the Dutch regulatory body, where the Dutch banks have approached. It's an association of Dutch banks which has approached the regulatory body and the Parliament for some sort of amendment there. But we have not heard anything, any amendments so far in the last year and a half. So that is about lack of regulatory guidelines, which has impeded this growth in data sharing. And the third, again, this is something which is institutional, the data quality issues that I was talking about. So if information has to be shared, first of all, the quality of data has to be accurate, consistent, complete, and it should all be at one place. So most organizations that I know, that I interact with, we've seen that there is fragmented data. So all that, if just customer data is not there at one place. So when you open a savings bank account, there is some customer data in one database. Then when the same customer goes to open a loan account, again some additional information is captured, but that is there in some different database. Again, when this person wants to open a card, now this information is there again in a different database. So for the same customer who is taking 3 different products, for example, a savings bank account or a normal checking account, say a loan product and a credit card, this same customer is residing in 3 different databases with fragmented information, because everywhere you would have given some incremental information. That information is fragmented. So this is also one of the challenges, that if the organization itself is not in control of its data, how good would data sharing do? So first of all, this data quality has to be taken care of. So Janisha, is there something you would want to say? I see you nodding, but I'm not sure if it's something you want to say, or you're just listening.
I have a question both for yourself and the audience, and I realize we only have 20 minutes left. So there is a poll question we had on the previous slide. Did we miss that?
No, here it is.
There you go.
Yeah.
And while the audience is working on the poll, so friends, the question is, do you believe that info sharing models such as the Patriot Act 314B should be mandatory? While the audience is working on the question, Sujata, I want to ask you to reflect on where you stand. There are 2 schools of thoughts about data sharing. One believes that financial institutions need to do better. And there are, comments in the chat about how BCPIF, certain regulations even within Canada, or programs rather, that prove to be barriers when it comes to sharing information between institutions. There's also several silos that get in the way even within organizations. So where do you stand? Is it regulators who need to come up with better regulations to give institutions a regulatory upside, or is it FIs who need to invest more in their programs?
Sure. That's really very interesting, and I'm glad that the audience are also involved in the process. That they're also thinking about these data challenges, whether institutions have to take care of it, or whether there is something regulators can do about it. Well, I think. For me, the answer would be both ways, because in the previous slide where I was talking about, one is the regulatory aspect and the second is the institutional aspect. So just an extension of that is, yes, there are barriers, like I was mentioning, that data is fragmented. And that is not good, because this is again a loophole which is being exploited by a lot of criminals, because they know that the entire activity is not at one place. So when they have to commit their crimes, they would not send the entire money through one product. They would break it up. Even if they are using the same financial institution, they would break it up and use 3 different channels. So they might use a cross-border transfer, they might use a domestic fund transfer, they might use an international card. So because data is fragmented, the bank would not be able to catch it, because if we talk about, say, US's CTR, where there is a cap of $10,000. Now, if the customer data itself is fragmented, how would you know that this is the same customer who has actually made, $9,000 transaction in each? You would not know, unless you have some way of reconciling that all these 3 transactions belong to the same customer, right? So in terms of institutions, there are 2 things that I could think of. There could be many more. One is, if they don't want to change the systems, because the databases may be large, there's a lot of legacy system there. If they don't want to change that system completely, they might want to use some sort of entity resolution, where you pool all the data about one single customer. So even if there are, say, 5 different databases, you can still resolve all of these databases. They roll up to one customer. So this is called entity resolution. So the example that I gave, that if one customer is making, say, 3 different transactions through the same bank, but using 3 different products, right? So if you are making, say, a wire transfer of 10,000, say 9,500, if I have to break it just below 10,000. So if they're doing a 9,500 through each of the 3 different channels, and they are sitting as 3 different customers, right? So this entity resolution, what it will do is it will match up that all these 3 customer IDs actually roll up to the same customer. So then it will be some $28,000 worth of transaction, and then the bank can actually have an alert. It will still be a post facto thing, but it will be an alert based on which you can submit a SAR. So this is called entity resolution. This is without changing anything. You just apply that analytics layer. The second could be you actually get all your data into one common, say, data lakes has become very common now. So if you get all of your data into one common data lake, or even better, build something called a golden source, a single customer database itself, where the customer data from all of these different sources come together, they get deduplicated, they get refreshed. So what sits in the golden source is a summation of everything, but a better version of that. So this is where you have to build something called, a separate database is what you build, which takes in inputs from all the different customer databases, and this becomes a master database, whatever, customer master database, or whatever you call it. So these are 2 ways in which you can at least enrich your customer data. So you move away from that siloed angle to something which can give you more comprehensive information about a customer. So this is more about the customer data I'm harping upon, because the account and transaction data is something which is generated within the bank. So combining that is easier. But what comes from external sources, like customer may not always update, there may be inconsistent information. You also have to use external data sources. Now we're hearing of, see, corporate registries are opening up in every country. Then you have the adverse media, where you have to look at social media. Then there are very niche organizations, the fintechs, which are coming up, which are doing all this external research, and they are bringing you that data about depending on which customer segment you want, whether it's small and medium enterprises, whether it's money service businesses, whether it's about charities or corporates. So you have these fintechs which are doing these research. And of course, it's with a subscription that banks can purchase those and augment their own data without having to go out and do all this research themselves. So there are various means of, data enrichment has become a very, very hot topic now, especially because we are talking about data sharing as well. So that's very important.
I gather you don't believe in resetting the system, but I'll come back to that question. So let's look at the poll results now. For the most part, so I think many people agree with Bob Kapoor that it's more complicated than an unequivocal yes, which is what I am proposing. Okay, so let's move forward and let's see if that sentiment changes over time.
Okay. Oh, I think when this poll comes up, something happens to the screen. Right. Anyway, I know the problem now, so maybe I'll stop sharing and come back again.
So really something to ponder, and this has been proposed before. Do we need a complete reset, or are we okay with the current progression we're making?
So if you're asking me, I'm still stuck here, so I'm a little distracted. Yeah. So if you're asking me, Janisha, I would say we all agree that there has to be a different way of doing things, right? What we are doing now is clearly not helping, because again, we read a lot of reports where over $2 trillion of year dollars are laundered every year, and that is only an estimate. We don't know the exact count. And out of that, less than 1% is actually intercepted, or they are confiscated. So clearly what we are doing now is not enough, or it's probably a lot more needs to be done. And I would agree that there needs to be a very different way of doing things. But if I have to use one sentence, it's not a switch, it's a dial, right? If you have to move from the vicious to the virtuous, it's not an off or an on. It has to be a dial from 0 to 5, not a switch between 0 and 1. So there has to be a change. Even if we think of the last 50 years that I was talking about, from the Bank Secrecy Act 1970 to where we are now, there has been a lot, crimes have also increased, but there has been a lot of change, in the way that we manage our financial crimes also. So the payments industry, if you look at, the payments industry has undergone a phenomenal change. Even now we are looking at the ISO 20022, which is a completely new standard, which will add more data to every transaction. And in our field, the work that we do in financial crimes is so heavily dependent on data. So transaction data is, again, of utmost importance to us. In addition to customer data, we also need to look at account and transaction data. So this works very closely with the payment data standards also. So payments data also, if you see from where we were in the paper-based, it was mostly the check-based transactions. Now, I don't think anybody writes a check. So it's all mostly digital, right? Digital, wire, online, cards, payment. So there has been so much change in the payment industry as well. And they have actually moved to a very, they have moved. I mean, so ISO 20022 is the latest standard that I think even UK's, the chaps, the clearinghouse is also moving on to ISO 20022. So there has been a lot of work already. Now, if we have to move it to that switch, right, that from 0 to 1, it's not going to be easy to just completely throw off what we have done in 50 years and come up with something new, because that will also have a life cycle, right? So rather, if we were to look at a dial, right, so moving from a 0 to 5, I think we have some platform, we have some infrastructure. What is needed is I think we are thinking in the right directions. We are looking at data, we are looking at collaboration, we are looking at enhanced regulations also. And I think every regulator that you hear nowadays, whether it's FinCEN or European Union or Monetary Authority of Singapore, you see they are heavily talking about using technology, which is built in collaboration with the regulators themselves. So till now, the fear was that whether an advanced technology that is used by a financial institution, will it be approved? Because it was more like a black box to the regulators. It has to be explainable. But now we see that even our supervisors are coming along with these institutions saying that, let us build something together. So I think that mindset has already changed, and I'm sure, we are in that process. So yes, change is required, but maybe it has to be a gradual one. At least that's in my opinion, because if we switch off today, we cannot wake up tomorrow morning with an entirely new system. It may not be possible, because the financial network itself is huge. We are the amount of payments that is executed every day is enormous. So I don't think it can be done in like a switch. It has to be a dial mode. And am I going too slow? I'm just be conscious of time. I'm trying to explain more, but I'm not sure, Janisha, is that too slow, or?
We have about
15 minutes, right?
About 10 minutes, and there are some wonderful questions that I would ask you to address after. So about 5 minutes for your slides.
Okay. So again, in terms of collaboration and data sharing, I have picked a few examples of data sharing models in KYC, which are being called KYC utilities. And as you can see with the diagram on the right, I think many of you will already be aware that in terms of KYC, every customer earlier had to share information with every different bank separately every time there was an onboarding or a refresh. But now with the utility model, this becomes like a one-stop shop. So the customer can update his information into the utility. The banks can use that same utility, and they can also update that same utility. So it works both ways. And the customers then have the control, because they have, they update the information. They can provide access to the institution, the ones that they want to share information with, or they don't want to share information with. So this becomes, a much more deduplication of work for both the customer and the bank. So this is more of the utility model, where the banks come together, and the customer is also into that whole the whole ecosystem. So they share the information. They don't have to go to every bank to share the information. They do it once. They get a unique ID for every customer. So if they have to open an account with, say, bank A and then B and C, they just go to every bank and give their unique ID from the utility, and the bank can fetch those details from the utility. Then if the bank finds any additional information, they can also update it. So it's like a two-way process for the bank. So it obviously reduces a lot of duplication effort. Here I wanted to just quickly mention about one of the utilities which is in process of building right now. That's the Nordic KYC utility. It's again done by some six different banks in the Nordics across Sweden, Norway, Denmark, and Finland. And it has started with sharing corporate information, because information, the KYC data for corporates is much more complex than for retail customers, and that is why they have started with the corporates. These are a few that I have mentioned. R3, that's a Corda KYC. It's a blockchain-based KYC in France, and the platform is provided by R3. Then there is Mansa in Africa. UAE, Digino is it's just starting, so it's only in the conceptual stage. So digital innovation network. So these are some of the examples. Of course, there will be many, but just to touch upon how the KYC utility works. And then we come to AML. Now, how is KYC utility and AML information sharing different? KYC is only talking about customer data, nothing more than that. Whereas in anti-money laundering, we are talking about a lot more. So customer data is, of course, the starting point. Then you have, customer behavior, their activity, the red flags, their transactions, their networks, the accounts, the products that they're using. So it obviously involves a lot more. Now, there are two models in the concept of AML data sharing. There are two concepts. One is private to private, which is also called peer to peer. That is information sharing just between financial institutions. And then there is the public-private partnership, which is between the private institutions, that is the banks and financial institutions, and the public sector, that is your regulators, your FIUs, your enforcement agencies. So information, how can they be shared between these two groups? So there is a private to private model and a public to private model. Now, when we discussed earlier that these two models are being encouraged, but then not much had progressed so far because of the data privacy regulations, of course. And US Patriot Act, like I think you got one in the poll question. US Patriot Act has two sections, 314A and 314B, which specifically talk about this kind of data sharing model. So 314A is between the public to private, where it's also called, I think, request for information, RFI. That is where your enforcement agencies or regulators, they ask information from the institutions, and the institution have to respond back within a certain period of time. About whether this particular X person or X company is a customer of the bank, or they have been a customer for the last, say, 1 year, 18 months, whether there have been any transactions, and so on. So these kind of informations generally is asked in 314A. And 314B allows institutions to query amongst themselves. But what we have seen is, this is again my knowledge, I may not be correct here, but the 314B, that's information sharing between institutions, has not worked so much, whereas 314A, I think it's used quite often. So while there was this regulation, and again, this was only in US, I think a few other countries may have this, I'm not very sure, but the EU regulation also that I mentioned, EU, the 5th Money Laundering Directive, they have also now allowed it. But because we have this whole data privacy angle to look at, this is, we see a lot of different models emerging by using advanced technology. So I have another slide after this. I was talking about the Dutch, the Dutch 5 banks in Netherlands who have come together, and it's called Transaction Monitoring Netherlands. You see that at the bottom. And this was the example I was taking, that they are also trying to work around how to organize this data privacy angle. They have gone to their parliament and the regulatory authorities to make some amendment. But meanwhile, they are still working on pooling the transactions of all these 5 different banks together. Of course, they will be anonymized. So the customer data, the customer name and their personally identifiable information will be masked. And all the entire transaction of all these 5 banks in Netherlands, and these are the biggest 5 banks. So they will come together, and in their proof of concept, they've done the pilot, and they have actually identified very strong patterns, which has encouraged them. So this is in the process of being built right now, TMNL. I think Canada is well known for a number of PPPs. So they have all these, I think, Project Protect, Project Guardian. I think there are for every initiative, it is there for human trafficking, for, I think, drug trafficking, anti-money laundering. So I think people in Canada will be quite aware of this. The kind of information that will be helpful if shared in this collaborative model. Of course, these are the 3 types I have been speaking about: the customer, account, and transaction information. The beneficial ownership information is, of course, specific to entities, that is non-individuals. And that has been a very sticking point because, a lot of organizations and entities, they hide behind shell companies, and they have very complex networks. So you do not know ultimately who is owning that company. So identifying beneficial ownership has become like one of the top tasks. And as we know, the Corporate Transparency Act in US, which came into effect from 1st January this year, this also talks about the same thing, setting up registries, identifying UBOs. In Europe, you already have that. So these are the kind of developments that are happening, and these kind of information now. So once you have the registry, that becomes, of course, it will not become a public registry, what FinCEN sets up, or what is set up in the EU. They will not be public, but at least for financial institutions, if they make a request, they can have access to that information. So I think I'm up on time, but I'll just quickly in 1 minute, Janisha, I'll just talk about the technology that I was talking to you about, that the industry, because they are seriously thinking about sharing data. And while we are awaiting some regulatory guidance, what we are now trying to do is look at alternate ways of sharing data or intelligence without sharing the underlying personally identifiable information, which means my name, my social security number, my passport number, my documents, my photographs. So without sharing these information, how can I still share insights about the customer, which will be beneficial? So what the fintechs have now come up with is called privacy enhancing technologies. And you see a cute pair of pets sitting there, but that's just indicative that pets are lovely, yes, but then privacy enhancing technologies is something which is using data encryption in order to share insights without sharing the underlying information. So there are various protocols. Again, I don't want to get into the details because we are not here to understand the technology details, but there are several encryption protocols like homomorphic encryption, as you see here, HE, the homomorphic encryption is HE, secure multi-party computation, zero knowledge proof, and so on. So there are several kinds of protocols. And what these do is, if we are sharing data using these protocols, data will be encrypted while at rest, while in transit, and also while it's being processed or queried. So all the time, the data owner will not be aware of what information, what kind of query has come from the other bank and what kind of information is there in that query, what is being analyzed. So the response will also go back in an encrypted form, and it will be only decrypted to give just the response. So it will not again share the entire data from the other bank. So this is something which has been in the works for some time. So I think this is a huge topic in itself. We cannot cover so much, but I just wanted to touch upon this, that this is one of the emerging technologies, and a lot of regulators are also now working on this. For example, UK has worked on the tech sprint where they explored pets or privacy enhancing technologies. So if you're exploring this area of data privacy versus data sharing, you must look at privacy enhancing technologies. So I
want to ask one question.
Yes.
Actually, yeah, go on. Let's finish with interoperability, and then Dipansha is asking, can the new AMLA 2020 be looked at as a step in the direction for data sharing? And I just want to let you know we have 2 minutes left.
Okay. So no, I wouldn't say AML Act 2020 is about data sharing in the first place. So it is not so much about data sharing, but it is a step towards data sharing, because earlier you have these the UBO legislation was there when you had the CDD I think ultimate beneficial ownership. I think that regulation came in 2018. So banks were required to identify ultimate beneficial owners. But what came through in this AML Act 2020, and specifically the Corporate Transparency Act, is FinCEN has to now set up this UBO registry. So by the registry, it means that the entities would have to disclose their ultimate beneficial owners, and this would then become a database which can be used by financial institutions. Again, it will not be a public database, so not that anybody can query it, but financial institutions, when they have a reason to, they should apply and get that information. So I think that part, enabling a corporate registry, is what is a step towards data sharing, definitely. Janisha?
Yes, and interoperability, I'm just going to drop a link to the recent report by FATF, and I think that you have really done a tremendous job at addressing most of the questions that came up. You'd foreseen most of them. Suzanne, do you have anything to add?
No, I think that's amazing. Do you guys are done with these slides? I think we had another polling question, but we can skip that and see that if there is any other questions on the audience that you would like to share. I think we are good. We're good to wrap up. Okay, I think we're good. We don't have any final questions. Thank you so much. Thank you, Janisha. Thank you, Sujata, for an amazing session. It was very informative. You shared with us some great examples, and I'm sure that the audience learned a lot. Everyone, please feel free, to follow Sujata on LinkedIn. She always share a lot of great information there. And if you have any other questions that you want to ask, definitely feel free to do so. And make sure that you stay connected. We have another amazing knowledge series session next week that we are going to go through. And feel free, to follow us and stay connected to get to know more about what is coming next week. And thanks everyone for joining. Thanks everyone on the chat box for sharing great links and information. We had the pleasure to have Bob Kapoor, Joseph Ioso, James, Stephen, Glenna as well on the house. So thank you so much everyone for joining. And have an amazing rest of the weekend. I will see you next week.
Thank you all. Thank you all. Wonderful to speak to you all today. Bye-bye.
Thank you so much, Sujata. Thanks. Thank you, Janisha.
Thank you, everybody. Have a wonderful weekend.